which coincides with the Bitcoin halving cycle, is the global liquidity cycle. And that's the central banks creating liquidity for the markets and for the economies. So what they tend to do is if the economy gets too hot, they tend to raise rates, liquidity comes down, they withdraw liquidity from the markets, take away QE. We've seen this several times before. And what happens is asset prices come down because they need stimulus. So once you take asset prices down, what happens is the economy starts headed towards a recession or goes into recession, and the monetary easing comes back again because that's the natural state of affairs. So that's kind of how the world sets up. And right now, we're in the situation where we've got massive monetary tightening. Now, monetary tightening has brought down cryptocurrencies, not as bad as they were last time, certainly not the majors. I mean, Bitcoin, ETH, they got down to 70, 75%, which is, ETH last time, the last cycle in 2018 was down 95%, much like Solana is now, more on that later. And Bitcoin was down 85%. So we're seeing a less dramatic tightening because there's more people involved in the network, which is the growth of the network is more robust over time. We'll come more into that. So if you look at this chart here, this is the year-on-year global money supply versus Bitcoin. And you can see they're hugely correlated. Now, what's interesting, you see the tops of the charts, they're all missing because the scaling doesn't work. Because of the technological trend adoption, when you get the rallies, they tend to massively overshoot, even versus where liquidity is. And that extra is the extra trend that drives the markets forward over time. Now, every time we see these trends, the boom and bust, everybody shouts scam Ponzi, but that scam Ponzi phase is actually just driven by the monetary tightening cycle. Now, there is a lot of speculation in crypto, I get that, because there is, in most new technologies, we get that in technology stocks themselves. So right now, we are at the bottom of the monetary cycle. Going forwards, we know the Federal Reserve is going to start increasing rates at lower increments. I don't think they go much further than maybe this 50 now. Maybe they try and eke in another 25 and try and keep rates stable and then wait for CPI to fall below Fed funds rates, which I think happens March, April. So I think next year is a game of dramatically changing liquidity conditions. Now, I also have charts to show that too. I've got chart of global M2, and you can see it versus ISM. ISM leads it, inverted on this chart, and it says when ISM starts falling, global M2 follows and turns around. And that means because ISM is saying growth is falling, and therefore monetary liquidity needs to come back in to save and manage an overly indebted system. So that's the typical state of affairs. We're exactly at that kind of turning point. So that's where we are in the monetary cycle. I think we will see inflation fall much faster than people expect, and therefore stimulus will come. And I think the Fed are going to think or look somewhat stupid by about June, where I think inflation is going to be down closer to 2%. I mean, the year-on-year rate of change of oil prices alone is probably zero right now. And if oil goes to $60, where I think it goes, and we get into March of next year, that was the time from the Russian oil crisis premium of about $120. So oil will be down 50% year on year. That's incredibly negative for an inflationary environment. Owners' equivalent rents are rolling over, and eventually wage growth will start slowing down dramatically. So my bet is we probably get negative rates back in the end of 2023. Sorry, not negative rates, negative inflation, 2023, 2024. I think the roadmap that we use for this is the 1940s and 50s and not the 1970s that everybody thinks. So the 1970s was the only example in history where inflation came up, came back down, didn't go all the way back down, then shot up again. I think that was driven by demographics, and the Federal Reserve are fighting an old ghost, and it's not the ghost that they should be fighting. I think the more decent parallel is the 1940s to the 1950s, when everyone came out of World War II, the factories had to retool, so there was supply shocks, and then demand shock of everybody coming into the workforce again. That drove up prices 20%. It was a bigger event than COVID. And then prices collapsed, went negative 2, negative 3% year on year, then rebounded 2 years later, We got a secondary bout of inflation just from the mathematical numbers. The Fed that time around imposed yield curve control because they didn't want to raise rates and destroy the economy. I think we're going to see similar this time. Anyway, too early to tell, doesn't really matter for this point. This point is we're at the low point in the cycle. I think inflation is lower. I think the crypto markets are going to be explosively better this time around. Well, the adoption trend, if you see this chart of Bitcoin, that's the log trend of Bitcoin. We're 2 standard deviations oversold. We're the most oversold we've ever been versus trend. And we're at the point of global liquidity turning. And we've got, if you believe in it, the halving. It's all coming into place exactly at the same time. Again, really interesting. And here's the long-term chart, log chart of ETH. Same story, right on that big support level. And these kind of things are really interesting. The last time we got the cyclical cycle down onto the logarithmic trend, or to the bottom end of the logarithmic trend, was 2018, December. November, December 2018, we saw that puke, the final puke lower, which I think we saw in Bitcoin in October from the FTX, and I think we saw in ETH in June. What happened was that's when volatility came to the low and the market started picking up. That period, as soon as the Fed pivoted, was a complete change in markets. 2018 had seen the kind of falls we've seen now, about 20-30% falls. It was sharp, it was nasty, everyone was terrified. And then what happened was the Fed went, okay, sorry, yeah, we can see the economic data is falling apart, inflation's coming lower, so we're going to stop. And I think the S&P did about 15%. I think oil did about something similar. And then the NASDAQ did about 20%. Exponential age stocks, the growth technology stocks, did about 24%. Bitcoin in 9 months did 300 or 400%, as did ETH. So these were staggering gains that came out of that environment. I've always referred to it like a beach ball being held underwater because the adoption trend is still there. What's fascinating about the adoption trend this time around, particularly in ETH, is the volumes have remained reasonably high. The number of active users has remained high. The total value transacted, which is the other part of the Metcalfe's law equation, has actually come down as the price of NFTs has come down. But the other measures look like it's robust. 2018, we saw a much larger fall in daily active users because it was earlier in the network adoption phase. But this time around, we get to build on top of what we built on from the last cycle. So that makes me very constructive overall. So here we are on the long-term adoption cycle where Metcalfe's law kicks in, and this is the thing that drives the exponential gains. Every time we get to this situation, we get new highs within about 18 months, maximum 2 years. In fact, within 3 years, even if you bought the 69,000 high, in 3 years, you'll see it go through. That's how it's always worked. Would it work this time that way? I don't know, but probability is there because of this network adoption trend that we're seeing. So I'm expecting 2023 to be a decently good year and 2024 to be extremely good year. If you remember, I said inflation, I think, goes negative. So therefore, we will see much more stimulus and growth will remain somewhat sluggish.